Hey there, YouTube and Facebook friends. I wanted to do a video that I hope people find educational. And what I've been doing is I've been watching a lot of these YouTube videos that are really compilations of TikTokers who are talking about their student loans and just, now how they can't pay back the loans or how they have loans that have higher balances than their original loan amount, and then they just can't see how this happens. They just don't understand why. Hey, I've been paying a lot of payments towards my student loans, and yet the balance does not seem to be coming down. I guess at the rate they think it ought to be coming down. So what has become very evident to me is that people simply don't know how long-term loans work in terms of the principal payback and the interest payback structure. So I'm going to go through that, and if you find it helpful, if you know yourself, you might just want to skip out. But if you've got kids that don't know, or maybe if you don't even know yourself necessarily, you may want to stick around and watch this. But I'm going to play a couple of those TikTok videos first here to let you just kind of see the flavor of what it is I'm talking about. Okay, here we go.
So as it turns out, the student loans that I've been paying $1,500 a month for 2 years have a 17% interest rate. So what I thought I've been paying off for all this time, I'm actually, I owe more than what I started off with.
I always thought that the people who complained about student loans were the ones that had really high loans, that it's like you're never going to pay it off, so why are you even trying type of thing. So I was never worried about interest, right? Mine is only about 17,000, so I was like, I'm going to pay it off within the time frame. I was like, I don't have to worry about interest because mine isn't that bad. That's literally what I thought. So today I was like, you know what, let me just sit down and do the math because I've been making payments, so my loan should be going down by a lot. That's not really what happened. I did the calculations and my beginning balance was 16,417. I have made six payments of $180, a total of 1,070. My current balance is 15,827. It has been reduced by $590, which means 480 of those other dollars went into interest, which means that I have literally paid half of interest.
All right, so I've kicked off to the side here just a little bit, give myself a little screen space to pop up another window, talk about some of the numbers here. But basically, the way longer-term loans work, and when I say longer-term loans, I'm talking about things like student loans, talking about things like automobile loans, home mortgages, anything that is extended out with a definitive number of payment terms at some fixed, doesn't have to be fixed, could be variable, but let's just keep the simple case and use the fixed rate loan. And basically, you look at the interest rate, you look at the number of payments, and then there is a payment amount calculated based on that. Now, the way that banks and other lending institutions do this is through a process called an amortization schedule. And an amortization schedule takes and it looks at the payments, and there are equal payments across the duration of the loan, that at the end of that term, the last payment completely pays off the principal balance and any interest that is still, owed on the loan. All right, so that's how it works. Now, it's apparently not very straightforward to people that the way these loans are structured is you are paying a larger portion of interest. In other words, there's a greater percentage of the payment that goes towards interest at the beginning of the loan than at the very end of the term of the loan. And I'm going to attempt to kind of show you why that happens. But first, let me just run through an example here. And the way I'm going to do it is I'm going to do it on a financial calculator. I've got a finance calculator app on my phone, and it is the Hewlett-Packard 12C app, and I've had a Hewlett-Packard 12C financial calculator, business calculator. This one I got in 1988 when I graduated from Georgia Tech, started working at Alcoa, and I've had. But anyway, I've also got the app on my phone and my iPad. And what this does is it lets you put in the terms as you would see a loan structured. And let me just give you an example here. Let's say that I've got a $100,000 loan that I'm going to take out, and I'm going to take that loan out for 20 years. And let's say that I got a interest rate payment of 6%. So what I do is I say, okay, the present value, so this PV here, is equal to $100,000. Okay, so if I type in 100,000 and I type in and I hit present value, it stores that present value in a register in the calculator. And now I'm going to put in the number of payments. Now, the Hewlett-Packard calculator does it pretty nicely. If you say 20 years, I can type in 20, and there's a function here that says, let me do 12 times that. So it's 240 individual payments over the course of the 20 years. Now, assuming you're paying back on a once per month basis, which most loans are structured that way, although you can pay back early in many of these loans without penalty. So there's 240 payments in this. So I've got $100,000 for 240 payments. And then I've got an interest rate. Now, the advertised interest rate is always given to you in terms of an annual percentage rate. I'm going to assume right now that our annual percentage rate is 6%. And so I come over here and I type in 6, but that interest rate is an annual rate, and you are making payments on a monthly basis. And that's important because your interest rate, while it technically is quote unquote 6% a year, what it really is it's 0.5% a month for 240 months. That's important. So again, the HP calculator makes it very simple. I come down here to my function key again. I go up here to I for interest, and I hit 12 divide. So it puts in my 0.5% interest on a monthly basis. All right, so now I have all the information that I need. I've got the number of payments, I've got the interest rate, and I've got the loan amount. And then all I have to do on this particular calculator is hit payment. And it comes back and it says your payments over the course of the loan, 240 payments of $716.43. So that's what your payment is. Now, where I see a lot of the TikTokers start having panic attacks is they make 5, 6, 7, 8 payments, and they think, okay, well, if I'm paying, $700 a month plus, that, hey, at least probably 600 of that is going towards the paying down the principal, and then the rest is interest. Now, again, they obviously don't know how the interest is calculated, which I'm going to show you in a little while, but that's probably what they think. Now, I can very easily tell you what the first payment of interest is on this loan. And the way I do it, there is this amortization calculator on this particular app. And I say, okay, if I start off at 0 payments and I enter that, then after 1 payment, I'm going to look at the amortization. And what it tells me, the first number it gives me is the interest payment. My first payment of $713 is made up of $500 in interest. If I want to look at the other register, how much principal did I pay, then it's going to be just 713 minus the 500, or in this case, $216.41. So you paid $500 in interest, and you've paid down now $216 off that $100,000, which means you still owe $99,783. All right. So that's kind of how the amortization schedule works. Now, if you pay that off over the 240 months and you make the full payment each and every month, then you're going to work that loan down over the course of the 20 years. Now, here's where a lot of, I think, student loan borrowers get in trouble. So if the payment is $716, and let's say that you were working with a lender who was, if you said, hey, look, I'm not going to be making that much money starting out. I mean, $716 would take everything that I make after I've paid all my other expenses. And they come to you and say, well, we could probably structure this loan to where you only have to make, $250 a month payments initially. And they don't really tell you what initially means, but they give you that option. Well, what does that mean? So if I paid $250 on that $100,000 loan, that should have accrued $500 interest the first month that it was outstanding. If I pay $250 of it, well, what that's saying is you haven't paid any of the principal, and you failed to pay $250 of the interest payment. Now, guess what happens to that interest payment that was not paid? It simply gets added back to the balance of your loan. So now this $100,000 loan that you took out is now equal to $100,250. All right. So I think, again, a lot of what I'm seeing with people said, hey, I took out a $50,000 loan, but I now owe $70,000. Well, there's really only one of two ways that can happen that I know of. Now, there may be others. Some financial experts might be able to tell me this. But either one, you've got a payment structure that is not a true amortization, so you're not paying back enough to cover both principal and the interest in any given payment, so your interest just keeps adding back to your balance. Either that or the other one, and I think this may actually be the case for a lot of people in this situation, is when loans went into quote-unquote forbearance, meaning you did not have to make any payments for, let's say, 5 years. Now, I don't know what the rules were in terms of interest accrual, or whether private loans had different rules than government loans, whatever. But I think what we're seeing happen there is that you had these big loans that never had a single payment. So all of the interest that was not paid was still being accumulated over that time and is now being added back to the overall balance. That's what I suspect. I don't know any other way that you can take, say, a $150,000 loan and make payments on it, and at the 5-10 years later, now suddenly owe $300,000, which I'm hearing some people say that they're doing that, but who knows? All right. So that's how a payment schedule works. Now, in my next video, I'm going to attempt to show and explain to people why the interest is so front-loaded. All right. And it has to do with the length of the term and the fact that your interest rate is really a monthly interest rate, and the annual percentage rate can sound a little misleading. All right. So I'll save that for the next video. Take care.